Hello and welcome to today's market update. Let's take a look at how US stocks closed last Friday. It was a classic case of weekend risk aversion combined with data speculation. While pre-market futures initially rose on stronger than expected US second quarter GDP numbers, which came in at 3% versus the expected 2.5%, the market ultimately chose to take profits and reduce positions. The strong data actually reinforced expectations that the Federal Reserve will keep interest rates high, which put pressure on high-valuation tech stocks. This led to a clear divergence between the Nasdaq and the Dow Jones Industrial Average. The Dow managed a slight gain while the Nasdaq and growth stocks faced significant headwinds. The main flow of capital shifted from risk appetite-driven moves to defense and hedging. Money ultimately flowed into gold treasury bonds, which saw yields remain elevated, and some defensive sectors. Let's get into the numbers. The Nasdaq closed at 24,975.82. The S&P 500 finished at 7,411.98. The Dow Jones ended at 51,947.25. The VIX Volatility Index settled at 18.58. The 10-year Treasury yield held steady at 4.68%. The dollar index edged lower to 101.31. The offshore Chinese yuan was stable around 6.7678. Cryptocurrencies were strong. Bitcoin rose 1.57% to $65,424. Ethereum gained nearly 4%. On the other hand, crude oil was the weakest asset of the day. WTI crude fell sharply by 5.22% to $84.65 a barrel. Spot gold posted a modest gain of 0.55% to $4,093.30 an ounce. Looking at market sentiment, the fact that investors did not chase the market higher on the back of the strong GDP data but instead sold tech leaders before the weekend tells us something important. The core contradiction driving the market has shifted. It is no longer about a soft landing versus a hard landing. It is now about a strong economy combined with persistently high interest rates. The old logic of good news being bad news has returned. The VIX hovered around 17.5, but its cumulative weekly gain was over 6%. This suggests that volatility is building and the market is not truly letting its guard down. Now let's review the global market path. In Asia, the session saw Chinese A shares perform weakly. The Shanghai Composite fell 1.61% and the Chi-Next index in Shenzhen dropped sharply by 2.65%. The market had already priced in potential new U.S.-China technology export controls over the weekend. Semiconductor stocks and growth names led the decline. The dollar-yuan exchange rate was relatively stable around 6.76, indicating that capital outflow pressure was manageable but internal risk appetite was extremely low. Data from the European session was missing, so we cannot provide a detailed review there. However, U.S. equity futures showed no clear directional guidance between the Asian close and the U.S. Open. This suggests that European markets had a weak transmission effect on U.S. stocks, which were mainly driven by the U.S. GDP data and weekend news flow. In the U.S. session, stocks initially rallied after the Open but quickly reversed lower. The semiconductor index and tech leaders like Nvidia and Tesla came under clear pressure. Growth stocks corrected broadly as Treasury yields rose. Near the close there was a wave of panic selling. This was an early pricing of weekend news, particularly the anticipated new technology export controls. A key inflection point came about 30 minutes after the U.S. Open. The positive GDP news was quickly digested and the market shifted to pricing interest rate risk. The 10-year Treasury yield at 4.68% remains the anchor for all asset pricing. As long as yields do not fall, the valuation pressure on growth stocks will not ease. Looking ahead to Monday, we have several verifiable predictions. First, we expect the Chi-Next index in China to remain weak, opening lower and then trading in a narrow range with a decline of between 0.5% and 1.5%. Second, the energy sector, particularly WTI crude and oil services stocks, may open higher with gains of 1 to 4%. However, we need to watch for a possible sell-off after the initial pop. Third, the 10-year Treasury yield will likely remain elevated in a range between 4.65% and 4.75%. Let me give you a clear directional conclusion. The current market is being driven by a dual engine of interest rates and geopolitics. The weight of direct trading on macro growth data is declining. Our strategy recommendation is to stay on the sidelines or use light hedging. We do not recommend chasing tech stocks lower, nor do we recommend going heavy on commodity rebounds at Monday's open. If the 10-year Treasury yield breaks above 4.8% and holds, all risk assets should be avoided. Our probability assessment for today's session is 20% for an up move, 40% for a sideways move, and 40% for a down move. Thank you for watching, and we will see you tomorrow.